Okay, now we come to another interesting concept in option expert in learning this option trading. That's open interest. So what is an open interest? We always know that any contract when it is traded, there is a buyer, there is a seller. There are two parties to make it to one contract. The volume is one. Yeah. Now, what is this volume? Is the number of contracts traded during the day. But what could be the open interest? Open interest is only the number of positions which are open, which means number of how much ever contracts that are written for which there is a buyer. Now, let's see, let's try and understand this with this example. Now, let's take, I would like to take some two characters like Anand and Sangeeta. Now, there is an Anand sells one contract to Sangeeta. When Anand is selling, so it is -1, who is a seller, and for Sangeeta, it is +1, right? A +1 contract. The open interest is only one. Yeah, there are two parties, one trade, but the open interest is one. Now, let's say Anand will sell two contracts to David. Now Anand is -3, he was -1. Now plus two contract which is sold is -3. David is +2, and Sangeeta of course is +1. Now the total open interest is 3. Total open interest is actually 3. And what happens? Anand sells 6 contracts to Sangeeta. Again, total sell for Anand is 9. And then David is +2. And then Sangeeta is +7. From +1, she became another 6 contracts added, it's +7. Total open interest is now 9. So now let's see what happens as it gets interesting, right? Now suddenly Sangeeta will change hands. Sangeeta will sell 3 contracts to David. See, Anand, who was -9, remains at -9. So David, who was at +2, adds 3 contracts. He becomes +5. And Sangeeta from +7 becomes +4. The open interest remains 9. Now, can you see the volume is actually going up? The volume is definitely going up, but the open interest remains 9. Then let's see what happens. Now, at this stage, we already know that there is one more person who enters into the scenario, that is Dinesh. Now, what happens? Dinesh will sell 9 contracts to Anand. So obviously, Dinesh will be -9, and Anand, who was -9, becomes 0, but the open interest remains 9 itself. It's only change of hands. So open interest will remain now. Now, let's see what happens in the next step. Yeah, Dinesh actually buys 4 contracts from Sangeeta. So Dinesh, who was -9, becomes -5. +5 he was actually picked up from Sangeeta. So Sangeeta is 0. David is still +5. Now what happens in the next step? Dinesh buys 5 from David. So Dinesh is 0, David is 0, open interest becomes 0 now. All trades have been nullified. But the volumes have kept happening. As you could see, there were volumes which was built up, but the open interest became 0. This is how open interest is calculated. Now, based on this, if there are more people writing, it doesn't matter it's a call or a put, to how many contracts are being written, whether it is on the call side, whether it is on the put side. That is where we will be able to analyze put call ratio based on studying this open interest. See, studying open interest is not complete or comprehensive in its own nature, but it is definitely one of the best studies. It will work along with various other studies which you will be doing, which you can apply to understand the trend in the market, the direction in which the market is going to go up. Now, let's move on and try and understand a few other concepts. Okay. Now, open interest is part of a study. Like as I told you, it is not a complete package by itself. It is a part of a study. So basically, trading cannot be carried based on just one or two findings. That's why only let me clarify it to you here. Like Nifty as well as Bank Nifty, these two indices has enough volume as well as enough open interest, so it can be, the direction can be studied or the trend can be understood. Whereas in most of the stocks, out of the 140 stocks, I'm not even sure that more than 7 or 8 stocks you can actually study open interest. There will not be enough or a conclusive study to understand the direction for these open interest. Open interest can only be studied in the presence of volume. If there is substantial volume there is a substantial if there is a substantial volume and if there is a substantial change in open interest, then the direction or the trend can be ascertained and not otherwise. Additional exploration is needed to confirm the findings. As I told you, this is not complete or comprehensive in nature, but this is going to be part of various other studies which a trader will be carrying. Now, so when does it work? As I told you earlier, open interest works on liquid stocks. Yeah, it only works on liquid stocks. And we know that the highest liquidity is there in the index, the top 50 traded stocks, and of course, the Nifty and Bank Nifty, current month and near month, and definitely not the later part, not the later contracts, but definitely the current and near month, we might find some kind of an open interest. It works only when contracts are approaching expiry. Now, when do I study this? Usually the last Thursday the contracts expire. Maybe I start studying this 4 or 5 days ahead of it. Maybe I get an idea of in which direction it is heading. This cannot be studied suddenly in a standalone. We only know what is going to happen in the couple of days. The couple of days, what is coming up, we will definitely know by studying this. And small stocks and illiquid stocks do not even resonate with the study. You know that there are not enough volumes, and definitely the open interest cannot be taken in any direction. So there could be manipulation also possible. So it won't be possible. So this is where the open interest study will work. Now, how do you read this accumulation? Initially, what does our mind say? When people are bullish, they buy calls, right? People are bullish, they buy calls, which means if calls are getting accumulated, we always think that market is bullish. Yeah, if market is bearish, there will be a lot of put accumulation, but we are wrong. Remember how actually the contract begins. The contract only begins when there is a writer, somebody ready to issue the insurance. A writer is needed to actually to start a call or a put. So the most important here is actually to understand. See, when the call open interest is going up, which means call writers bet against market going up. I'll give you a simple example. Stock is trading, a highly liquid stock is trading at 100 rupees and 110 call. There are a lot of accumulation. 110 call, there are a lot of accumulation, which means there are a lot of call writers who actually issued a lot of contracts, which means they are betting that market is unlikely to go above 110. Remember, the insurance, what happens in insurance? Who wins end of the day? Yeah, even when you see actually what happens, even you go to casino, who wins? The house wins end of the day, whether it's a casino, whether it's the insurance, whether it is a market, end of the day. Who are the writers? These typically people who write contracts are not individual traders, not much of retail traders like you and me. Yes, maybe we just take a small part, but these are large institutions, bigger players. They are the people who are actually who control the direction of the market. So higher call open interest means call writers bet against market going up, which means there is a sign that market's not likely to move up, or it could be bearishness. Now, exactly opposite. What happens when the put accumulation is going up? When there is a huge accumulation in put, which means put writers bet down against market. Markets are not likely to go down. It's likely to hold at a particular level. It is likely to move up, but is not likely to decline, which means bullishness. Now, conveniently or conventionally, we always thought calls we associated with bullishness, puts we associated with bearishness. That is not so when you really have to study the open interest. Open interest accumulation tells this part. I know the best takeaway in this section is actually this part. When we understood that, increase in call doesn't mean bullishness. It actually tells there is a bearishness. Yeah, same way, increase in puts doesn't mean bearishness. It means that market is unlikely to go down and it might actually move up. And then, so let's move on and try and understand this now. Now, what is OAC? Whatever we were talking about, the increase in call open interest. Writers bet against market going up. The big players' chances are very high. These institutions or whoever we are talking about, their chances are very high, much high, and stocks are unlikely to cross the strike. So this level acts as a resistance. Now, wherever at whatever level this call open interest is built up, we have seen it acts like a resistance. Similarly, when the put open interest increases, writers bet against not going below the mark, and there is a large institutional players and players write options, and then stock unlikely to go below the strike will act as a support. So in index, suppose you're seeing in Nifty, there is a huge accumulation in 11,300 put, which means market is unlikely to go below 11,300. Similarly, there is a huge call accumulation at 12,000, means market is unlikely to cross 12,000. So you need to watch this on a continuous basis. Now, if I'm watching it, it is 3 days to expire. I'm watching it in the last week, and market is likely to expire in another 3 days. Where I'm watching it either on Monday or Tuesday, I'm seeing it. So if I see this pattern, maybe I'll know that market is unlikely to cross the 12,000 mark. That is where it has it has a resistance there. Now this gives rises to another concept. There is something called a pain point. There is also something called pain point, which means a price level at which institutions or large traders don't lose money. That I'll be coming to you shortly. Before that, let us try and understand the put call ratio. Now, for every person, for every writing, every call writing, how many puts are being written? Now, this is what is called as a put call ratio. Now, PCR, in simple words, it's called PCR. Now, higher means more than one. If for every call, is there a put? Not necessary. At any given point of time, not necessary for every call there should be put, for every put there should be a call. Now, based on this, let's try and understand for every put, how many calls are there. If it is one, which means same equal, one is 1.1, which means there are more puts than calls. Yeah, 1.1 PCR means there are more puts than calls. Now that when there are more puts, what are we trying to say? Market has a great support and unlikely to move down or it is bullish. So more put options than call option, which means large quantity of puts return. They're betting against markets going down, but not necessarily bullish, but markets are unlikely to go down. Similarly, low put call ratio, we have seen markets, typically 0.9, 0.8, seen 0.6, also PCR, which means what? There are more call accumulation than put open interest here. So large quantities of calls are written. Now, this is again, betting against market going up. Market going up does not necessarily mean that it will crash, but it's unlikely to face resistance. Let us understand this very clearly. When you say market unlikely to go below, doesn't exactly mean bullishness, but there is a great support there. Similarly, when there is a call accumulation, which means there is a resistance, yeah, that doesn't mean the market has to crash, but definitely there is a resistance at that level. This is about the put call ratio. Now, when you watch this on a continuous basis, you'll be able to arrive at some understanding. Only when you do it on a continuous, you just see once in a while, one off, suddenly you see this chart, then you don't have to get confused. Now let's see how exactly it looks. As I was saying that, what do you mean by more than one PCR? Puts outnumber calls, yeah, put writers outnumber and may indicate bullishness, but only above 1.3, okay, may indicate overbought, or a reversal can't be ruled out. Even it can be the moment it reaches 1.3, the markets can turn overbought. That is where you come to know usually it reaches about 70% mark in an RSI chart. Yeah, usually, and it can remain there. I and you know that markets can actually remain overbought for a longer period. Similarly, when the low put call ratio is 0.5, which means what? Calls definitely outnumber puts, and call writers, which means call writers, number of writers also outnumber and may indicate bearishness. But below zero point 0.3 may indicate oversold, or this is the 30% level in an RSI chart. Even of course a trend, a bullish reversal is not also cannot be ruled out. It might happen, any of these things might happen between 1.3, yeah, when it is above 1, and below 1 when it is at zero point 0.3, you cannot rule out at a reversal also. Now this is about the put call ratio as well as the trend reversal which might happen. Now this is how exactly whatever you're seeing here, this is how exactly the chart looks like. When you look at, what you see here, 11.2 million calls and then 4.9 million puts. Definitely. Now here, all the calls basically are in red color. Whatever calls position that are being taken are in red color, and whatever green you are seeing is actually the puts. Definitely the calls outnumber. The calls definitely outnumber here in the volume. The volume is different, but the open interest, the change in open interest, as you can see, whatever marked below, you see those are the positions which are round up, which means calls that are getting wound up. The position is getting wound up, but the writing of call is happening. Yeah, writing of call is happening in those places. And definitely, as you know, that red bars at top, which increase that call increasing at that strike price. So sellers betting that market won't go up. As you can see, whatever level you are seeing there, 11,000. This is a position at 11,000. There is a huge position that is built up. This is just an example which is taken from Sensible. This is actually an example, one of the charts which I have taken from the Sensible. As you can read from this graph, so what exactly happens, red bars on top half, red bars on bottom half, which means, sellers are afraid and the market might not go up. Actually, it's a bullish signal. Again, the green bars on top half means that, sellers betting market won't go down, which means support. That strike acts as support. So green bars in the bottom, what does it mean actually? Which means puts decreasing at a strike. So sellers afraid that market might go down. It's a bearish signal. So this is how we can actually simplify an example of put call ratio. Now this is how exactly it looks. What I was trying to show you, I just wanted to enlarge and show it to you. It's very simple. 11,300. There's a huge buildup. There's a huge buildup of power, which means maybe this will act as a resistance. Similarly, at 11,000, there is a big support. As you can see, there can be a market can actually be somewhere stay between that. And here it's very clear. Look at the put call ratio. Put call ratio is about 0.7. As I told you, there are 23.5 million calls against 17.4 million puts, and it's about the ratio is about zero point 0.7. I don't have to tell you that what followed this. It's basically a small time fall, definitely a market taking a downtrend, on the subsequent days. This you need to follow it on a continuous basis. So what I'm going to explain here is basically an assumption. Now there is something called a max pain. What is this max pain? The point at which the option expiry is likely to happen. I'm not too sure, but you need to follow it on a continuous basis to ensure does it work. At this point, the option sellers incur least amount of losses. As you know, only the big players, yeah, people with a lot of depth in their pocket usually write contracts. Yeah, a trader, a retailer like you and me cannot get into an option writing too much of, we cannot decide the trend. We cannot write substantially. Yeah, one or two contracts we can write, but not beyond a point. We cannot decide the direction of the market. Now, how does it work? Sellers or writers dominate the market, so they always win. So expiry happens with least damage to the sellers. So this is how it works. So now this is a theory. It is not supported by any academic, or as I told you, it is not supported by any evidence, but there's only a study. Possibly you should study more. You should actually watch this more, keep following this, and come out with your own idea of how exactly the max pain works. But rest of the put call ratio and the open interest, which I explained, remains standard learning from this session. Now I want you to go back and use Sensible. Now I'll be doing practical sessions where I'll get into Sensible and actually show you how exactly, like you can see put call ratio in a real-time basis and see how exactly markets have followed also. Thank you for staying with me in this session, and looking forward to have you in the next session also. Thank you.